Thank you all for joining. For those of you who don't know me or don't recognize me, since I traded in my professional barber with years of experience for a second-year politics student with a beard trimmer, my name is Edward Stone. I'm a partner in the London office of Womble Bond Dickinson, and I work mainly with international clients advising on their wealth and succession planning. During this lockdown, we've all had to learn and adapt to new ways of working, collaborating, and communicating with our colleagues and clients. And whilst it's been business as usual in many aspects, one aspect that I in particular have missed have been the more informal, wide-ranging discussions that we typically have, perhaps over a glass of wine with other professionals, and discuss what is going on in the other parts of the wealth advisory sphere. And so I hope that during this webinar, over the next 55 minutes or so, we will get all of us the opportunity to break out of our sheds, our spare rooms, or whether we are locked down, and see which way the winds are blowing and how those might affect our clients and their structures. So before we actually kick off with the discussion, the great panel we've got for you today, if at any stage you want to ask a question, and please do, there is a question and answer feature which should be visible in your right-hand panel of your screen. If you're not already familiar with how this works, at the bottom of your screen, sorry, if you click on the right arrow, at the bottom of your screen, there should be three little dots that appear. This is the control panel. And if you click there, you should be able to open the Q&A. And then you'll see at the bottom of the screen a free text field where you can submit your question. And once your question is ready, simply press enter to submit. We have had a few questions already in advance, but please do ask more. We want this to be as interactive as possible. Questions then can be submitted at any moment throughout the webinar, and all questions are anonymous unless, of course, you decide to put your name into the actual text. So now I'll ask a great panel to introduce themselves. I'll perhaps start with Tom Dupernex, a client advisor at UBS. Tom.
Thanks, Edward. Afternoon, everybody. So I'm a client advisor at UBS, and I look after a small number of clients, largely based in the UK, and also their trustees and liaising with their third-party advisors. My client base is largely composed of family offices, entrepreneurs, and finance professionals, with a blend of both UK domiciled and non-domiciled tax profiles. And prior to banking, I've now been at UBS for 7 or 8 years. I was a private practice lawyer for around 10 years, so have a great deal of experience and expertise on the structuring side as well.
Thanks, Tom. Next, I'll go to Grant Wilson, Chief Investment Officer of ARC.
Thanks, Ed. For 25 years, I was a global equity manager and executive director of a couple of fund management companies. The last 10 years, I've been the Chief Investment Officer of Asset Risk Consultants. We're out there to try and help our clients have the best experience of the fund management industry possible. And to that purpose, I spend most of my time thinking about investment policy and manager selection, and possibly writing report cards about managers. That's my world.
Thanks, Grant. So I'm struggling with the mute there. And next, Randall Krebs from Harbour International Trust in Bermuda.
Yes, good morning from Bermuda. I'm a Canadian-trained lawyer, member of the bars of Alberta, Ontario, and Bermuda. Moved to Bermuda about 15 years ago now, and I'm practicing with Harbour International Trust Company, which is an independent boutique trust company that resembles a multifamily office, except we retain third-party professional investment managers for our investment portfolios.
Yeah, thanks, Randall. And now let's go to Ben Grist, partner at Dixon Wilson.
Thanks, Ed. Yeah, I'm Ben. I'm coming here live from a rather eerie Chancery Lane at the moment. I've snuck into work for this. I'm Ben Grist. I'm a partner at Dixon Wilson. I've been at the firm about 17 years now. And I'm a chartered accountant and chartered tax advisor, and deal with sort of a broad range of tax and accounting issues for a wide range of clients. Their structures, their businesses, and basically everything that goes along with that.
Thanks, Ben. I've snuck into the office as well because the Wi-Fi at home is not great, or maybe that second-year politics student logging out the internet. And finally, Will Ford, my colleague for over a month now. I've not seen him in the office. Will.
Thanks, Ed. Yeah, I, in common with Ed, am a partner in the private wealth team at Womble Bond Dickinson. I advise UK and international families, their trustees, their family offices, and financial institutions on wills, tax, trusts, all aspects of wealth structuring and estate planning.
Okay, thanks. So the aim, and hopefully it's going to be a sort of a free-flowing discussion, is we're going to start by looking at the broader market outlook, and then look at some of the issues being faced by our clients, look at what opportunities there are there to be taken at the moment, and then we'll indulge in some speculation about what may be over the horizon and how clients can ensure they're best placed and able to respond. And again, if you've got any questions, please do send them in through the question and answer sidebar. But let's get going now. Without any further ado, it seems that the worst of the pandemic is behind us, hopefully now, at least in Europe. But it's clear that we're going to continue to feel the social, economic and financial impact for some time to come. So Grant, I think for you, the burning question I have is, and I think what we'd all like to know the answer to, is who do you see as the winners and losers from the pandemic?
Well, the winners and losers that we see are strangely a continuation of trend. You know, healthcare has been very strong. Remote everything has been very strong. People use terms like cloud adoption and e-commerce and home work and home entertainment and home nesting. And these things all line up very obviously. The losers, you know, business travel, the high street, office space, tourism, cinemas, theaters, live entertainment, anything with high leverage, anything with a big exposure to the energy business, Luddites in general, people who are not happy snipping on audio-visual channels, they'll all have a hard time. The background for the COVID bear market, as we might refer to it, was very unusual in the sense that it was a very quick sell-off, and it's been quite a powerful recovery, but within the easy headlines for the market were a number of very harrowing tales. Economically, it's been very rare for large industries just to go from doing okay to zero revenues in a space of days, and that big hit is still with us. And the headline market numbers hide the fact that although the world index is only down 6%, the UK is still down 18% in general. And the NASDAQ, which represents it's skewed by the big technology companies in America, is actually up year to date, those numbers being year to date. So no change in leadership. The big tech companies are still the things that are making the running. And so there's quite a lot that's still well down and damaged by the bear market. A couple of things that stick out that I think everybody will be interested in: income. You know, bond yields are so low now, and dividend cuts for any one of a number of reasons are very substantial this year. So anybody looking for income has a challenge. And although we generally tell people not to make big policy changes during times of stress, there will be substantial changes in financial circumstances for lots of people out there. And when the circumstances have changed, you do need to make some big changes in policy. That's probably enough for me for just now.
Okay, thanks. Tom, does that chime with what you're seeing with your clients, in particular perhaps the income challenge that Grant's just mentioned? And I suppose another question for you is what has happened, has that changed your clients' attitude towards risk?
Yeah, it's a very good question. One of the key things we try and do with our clients is ensure that they're in a position whereby they have a plan, so that when unexpected events like this come along, they're not overly challenged and can instead look back to their roadmap of what they're doing with their assets and why they're doing it. We have a plan that we put in place that's called our 3Ls, and we encourage clients to think of their assets in 3 pots. First of which is their liquidity pot, and that's the funds that they will need to essentially maintain their lifestyle over the next 2 to 5 years. So that's paying school fees, mortgages, their general living costs and any, of course, one-off expenses they might foresee over that period, purchasing a boat and another holiday property, for example. We tend to put those in very low volatility assets so that when you have events like this, they don't impede people's day-to-day spending. Once you've got that pot sorted, you can then start to think about the second pot, which is your longevity pot. And those are the assets that you think you're going to be using during the course of your lifetime. With those assets, you can afford to take a little bit more risk because you've already got that buffer of low volatility assets that you can use over a 2 to 5 year period, which historically is long enough for even the most vicious and long-term bear market, such as the 2008 crisis, to then go back to the level it was at before. So you can then start to look at perhaps having a more growth-oriented portfolio there, and perhaps an addition of some asset classes where you might get a liquidity premium, so private markets, hedge funds, etc. And then the third part is your legacy pot, which is the assets that you don't think you're going to be using in your lifetime. So that can be the pot you're looking to pass on to the next generation. It can be the pot that you see being there to meet your philanthropic goals. Now, the reason why I talk about those is because if you are thinking about your wealth in terms of those assets, rather than sort of amorphous opportunistic mass that you might put into investment A, investment B, depending on how you feel on any given month, then you're in a position whereby you can be much more robust in terms of your approach to crises and shouldn't need to have any substantial portfolio changes as a result of the crisis. Going to Grant's point, if you're of the belief, as we are, that income levels from assets are going to be depressed, then clearly changes will need to be made. But what you won't need to be doing is selling down assets at the bottom of the bear market in order to achieve liquidity. You can instead take a measured approach to how you're going to ensure that your wealth sustains you for decades and generations to come.
Thanks, Tom. I'll move on now to give. Before I come back, I think to you with some more questions to give the others a chance to speak. And Randall, listening to that, typically trustees take a long-term view. So you would be in the L for legacy under Tom's three L's. Do you want to comment on any aspects of what Grant and Tom has said and how your beneficiaries are reacting?
My first comment is personally, my portfolio has 4 L's. The biggest one is L for losers, and that's why I'm not an investment manager. Tom is quite correct. Where you have a trust that holds investment assets, generally they're held with a long-term view for the benefit of the family as a whole. The objective being that it's going to ride out these little blips or these large blips along the way. And as we've seen, the markets are starting to recover in certain areas. In other instances, the trust might hold other types of assets. For example, a family business, shares of operating companies, or non-financial assets like art or yachts or planes or toys. And in those instances, you may find pressure on the trusts to support, for example, the family business, which is under water due to the pandemic. Could be their yachts underwater too. But so it impacts not only the investment portfolio, but how the trust might need to support other assets that are being held for the benefit of the family. With regard to how the beneficiaries are reacting, they're reacting as generally the public would react. So there's a portion of the public that's oblivious, right? They don't know about their investment portfolio. They don't really care. As long as the checks come in, they're happy. Then there's others who are panicking because they see the possibility of their income stream drying up or the erosion of capital. And that's where it becomes important to assist those beneficiaries and get them in discussion with the investment managers and allay some of their concerns that this isn't going to impact them over the long term. Then you've got the e-traders, the guys who have the E-Trade account. They think they're the next Bloomberg, and they're looking at it with 20/20 hindsight. So they're second guessing everything that's been done in the last however many years and how they could have done it better. So it comes back to the need to communicate with the settlers, the beneficiaries, the families, to assist them in monitoring how this is impacting. They're also, because of the pandemic, concerned about issues that they've overlooked in the past. They've realized now that maybe they're mortal, and they might have to give some consideration to passing assets on to the next generations. So they're revisiting their structures, they're reviewing them, they're updating them, perhaps creating new structures for the benefit of others. We also touched on briefly the philanthropy. You've got a group of people who are now saying, I want to use a portion of my assets to deal or assist those that are assisting others during the pandemic. So communication is key, and making sure that you bring in the professionals who are going to address the concerns that they have regarding their investment portfolios.
Thanks, Randall. Let's turn to Ben for a different view. How is the pandemic affecting you and your clients on the accounting and compliance side?
I mean, I think it's largely sort of business as usual. I think a lot of the headline comments and a lot of the focus in the accounting and tax world recently has been on things like the furlough scheme, and there've been sort of a few high-profile announcements about sort of being able to defer certain taxes or payments of certain taxes, and even sort of accounts filing deadlines. But actually, for many people, it is business as usual. You know, whilst everything is put on hold in our sort of personal lives and business lives, you know, accounts still need to be prepared, and the timing of the pandemic is sort of is quite tricky in terms of accounting, because, you know, a lot of companies, a lot of our clients' businesses, their year ends tend to be either 31 December or 31 March, probably the most common one. So actually, we're right in the thick of sort of having to start preparing accounts for businesses, and some of these businesses, you know, the future looks uncertain, shall we say. So we're already starting to see issues, having sort of quite interesting conversations with directors and trustees who own companies about, you know, presenting accounts. In an ordinary year, the sort of discussions which might get mentioned, you know, covered in a couple of sentences. But this year we're having sort of much longer, more detailed discussions. Topics like, I mean, ranging from simple stuff like, okay, you've got debtors, you know, how recoverable are they? You know, what's the likelihood of them sort of going bad, to things like stock impairment. You know, if you're carrying a lot of stock which can't be sold, you know, should that be written down? To more fundamental issues like investment properties is sort of a big thing we're seeing. You know, if you've got a 31 March year end, if you're having to reflect your investment properties, real estate at fair value, who's to say what fair value of, you know, properties, you know, in London or elsewhere are at 31 March? And that's sort of leading to, you know, people always sort of have a view on accounts, of sort of have a view on what they should look like and what we don't want to sort of say there's any uncertainty. But I think the reality is there probably is going to be some uncertainty in accounts being signed off around about now. And the other issue, that, you know, so the fundamental issue, which has to be considered for all accounts, is the question of going concern. You know, there's a standard basis that, you know, all accounts are prepared on a going concern basis, that the business is viable to continue for the next 12 months. You know, in the current times, you know, there are going to be businesses where all of a sudden that conversation goes from yeah, sure, you know, it's just another year, to all of a sudden, well, actually, how do things look? And is some disclosure going to be required from directors, from trustees who might be financing these companies, about sort of how they're going to be supported through, you know, the future uncertainty? And I think that all sort of brings into sort of the focus, sort of, you know, who is looking at these accounts and why do they matter? And people get very sort of wound up about things like EBITDA. I want it to be over a certain level. I don't want this disclosure or that disclosure. And I think there's going to be, I mean, my view on this is I think there's going to be a lot more difficult discussions between accountants and auditors and the directors of these businesses. But also probably, I would hope, more of an acceptance from people reading accounts that actually, look, we are going to see some, you know, we're going to see some difficult things in companies' accounts, you know, that are being signed off about now. You know, we shouldn't be surprised by that. We shouldn't be writing off a company just because, you know, its EBITDA suddenly drops for 1 year. Frankly, I'd be more concerned if you had a company that had no disclosures and sort of showed, you know, everything sort of sailing on as usual. You know, that would probably give me sort of more cause for concern. But it's really about, I think the message is starting to have those conversations now. I know we're all sort of locked down and we're sort of, you know, normal business is slightly being put on hold. But actually, I think if you've got a company and a year end has passed, I think now is the time to be starting to have these discussions and thinking about what those accounts might look like.
Okay, so encourage that for people in their companies. But what about individuals? And what are the implications for individuals who found themselves unable to leave a jurisdiction where they're not sort of tax resident beforehand, or we're not planning to be tax resident, so they've been stuck in the UK, US, and their day counts are getting higher. And are there any sort of other concerns if they then move countries and get quarantined and have to stay? How's that going to affect them, do you think, from an accounting perspective?
I mean, the question about sort of residence and sort of where people are being sort of caught, or where they may be spending time, I think is a particularly technical point. We've obviously suddenly in the UK, as far as we're concerned, we've just spanned a year end. So you're sort of looking at two periods here. You've got the tax year running up to 5th of April 2020, and we have many people who may have been sort of trying to manage their day count, should we say, in terms of keeping under certain thresholds in the UK, or I'm sure that the same is true. It's equally applicable to other countries. All of a sudden, plans have gone out the window, and they are now stuck here, and they're concerned about sort of inadvertently triggering tax residence. And one of the slightly tricky things about the UK statutory residence test is you never know you're resident until after the event, after the end of a tax year. That's one of the challenges we face. And on the face of it, anyone who's sort of done a little bit of sort of Googling will quickly come across this point that there's something called exceptional circumstances, which is the UK's. We've had it long before this pandemic. We have a rule which basically says if you spend time in the UK due to exceptional circumstances, broadly defined as things beyond your control, then you can ignore, for certain purposes, up to 60 days in a tax year, because you had to be in the UK because of those exceptional circumstances. So on the face of it, a lot of people are reading that saying, "Oh, great, that's fine. Nothing to worry about." But actually, if you dig a little deeper, it's not quite as simple as that. The exceptional circumstances test only applies in respect of certain day counting, headline day counting. It doesn't apply in respect of some of the other tests that help set, whether you're resident or not here. And whilst you may have got comfortable for 1920, I came in March, I went over by a few days, I think I can deal with that. There are some clients who are still in the UK now, and we're June, we're a couple of months into the new tax year. I mean, we're just coming up for 60 days, aren't we, in terms of if you've been here since 6th of April. So I think the key message here is you really need to be taking advice. Don't rely on, just looking at it and saying, "Oh, exceptional circumstances will cover me." Surely the HMRC wouldn't ever come and try and, be difficult about this. But you've got to remember, a lot of these cases, HMRC will be looking at this, possibly a year or more down the line when you're submitting returns. And actually, in the cold light of day, when you're, in an environment where possibly the revenue are trying to, raise more taxes, who's to say how sympathetic they will be, and sort of will they really sort of reflect back and just think how uncertain things were now? So I think the headline comments are, you really need to be taking advice and tracking very carefully where you're spending time. Well, that's pretty easy. And more importantly, and also sort of whether you're working and what you're actually doing, to really take a view on it.
Thanks. And taking advice, that leads me to Will. We haven't heard from you yet. So, Will, Denny, you want to add on that?
Well, first of all, just to endorse what Ben has said about the statutory residence test, it's complicated. It's very complicated, actually. As Ben has said, the exceptional circumstances relief on day counting only gets you so far. You always have to look at the connections. You have to analyse all of the tests separately, and the exceptional circumstances sort of help on your day counting, only assist with some of that, not all. So anyone who thinks they may be caught by that really should be taking detailed advice. Then sort of moving on to what might be coming down the track in terms of tax changes or in terms of opportunities for clients. First thing to mention is that asset prices, as Grant and Tom have been saying, may be lower, and certain opportunities may come from that. And there may be certain pressure to act as well, because tax changes may be coming, because the government is going to need some money. And there, of course, we've all seen the media and government sort of estimates of, or OBR estimates of borrowing, and estimates of 300 billion of additional debt that relate to the pandemic response. That's what we're talking about in terms of scale, maybe 100 to 300 billion. It's a lot of money. First, however, just sort of setting the scene on that, there's been a lot of noise about tax reform recently. There's been a lot of noise about growth of inequality. We've had Labour under Jeremy Corbyn's leadership. We had the Land for the Many report. We've had the OTS, the Office for Tax Simplification, and then the all-party parliamentary groups looking at reform of IHT. Then we've got academics and economists in the background talking about growth of inequality and maybe wealth taxes. That's just the backdrop to where our government, Conservative government, finds itself now, facing a pandemic, having to think how it's going to respond to expanding debt levels, and deciding whether it needs to raise revenue or whether it needs to keep calm and allow the economy to recover and prevent investors taking sort of fear and flight about significant revenue changes. I'd add to that, bear in mind, this government has already raised taxes. In their first budget after the election, they cancelled the plans to reduce corporation tax from 19% down lower. And the IFS said that that's scheduled to bring 7 billion over the next 4 years into the coffers. And they also capped entrepreneurs relief, which is supposed to bring in another 1.4 billion, I think 1.5 billion per annum. So it's already a sort of tax raising government so far. And it's important to note that it may not be necessary to raise taxes further. However, a few things do stand out. First of all, Ed and Ben, we've both talked about capital gains tax rates. They are historically fairly low at 10% and 20%, or 18% and 28% for property. And clients would be forgiven for being a bit nervous about that and thinking that they might be increased, or they might be aligned with income tax rates. So it's worth thinking about what clients might do if they want to protect themselves against that kind of rate rise. They might rebase their investments by selling them. And if they repurchase them, they need to watch that 30-day bed and breakfasting rule. So that's an easy one. They might start to accelerate gifts down a generation, thinking back to those inheritance tax reforms and the idea of structural change. That would be taking advantage of lower values to do that, a lower at-risk amount on their potentially exempt transfer. As Randall has said, if clients are not yet deemed domiciled, they might look to set up new trust structures, which can offer some forms of tax deferral. Obviously, if rates go up, tax deferral is worth more to you than it was before. Equally, clients may look to take distributions from existing trust structures. While asset values are low, those may be cheaper, or they may be able to access distributions which are matched to capital gains and benefit from the lower rates. So that will be important. Some clients may even want to wind up trust structures to take advantage of those issues. And one point there to be cautious about is if you have a non-UK trust with significant capital losses in there because of some of the issues that Tom and Grant have been talking about, be careful about winding it up. You may lose the benefit of those losses and you may wish you kept it going for a bit longer. So you might want to partially wind up that structure. So lots to talk about with clients. No client is the same. They all need bespoke advice.
You say lots to talk about, and probably they're going to need to talk to you, Ben, because I'm not sure all clients are going to have their records in the best of shape. I see Randall nodding there because we know his clients are, but Grant has said that the UK is still down, NASDAQ is back up, so the window of opportunity is probably closing. If clients do want to take advantage and do some of the things Will had said, can they still do so?
That's a very good question, and I mean, and it's something I quite often get asked. I mean, unfortunately, it's quite a technical point, but where you're talking about trusts making distributions or paying out benefits to UK resident beneficiaries, and that could happen either because we think there's going to be a capital gains tax rise on the horizon. All of a sudden, you might get beneficiaries say, "Hey, I'd like some money," pretty quickly, or you might get to a position where if you think, you want to wind up a structure, you might want to do it quite quickly, but all of a sudden you're thinking, well, how much is it going to cost me in tax? And one of the unfortunate things about the tax rules in the UK is, whilst you can ask me how is a dividend taxed, and I can tell you the answer to that. If a beneficiary of a non-UK resident trust receives a distribution in the UK, there is no capital distribution. There is no sort of quick answer to how it is taxed. Instead, there's quite a convoluted process, which in simple terms involves an accountant going back and measuring in UK tax terms what the historic accumulated income and capital gains of the trust have been. And this can, in certain cases, involve going back a number of years, in some cases back to the trust's inception, to work out what the level of these pools are. And actually going through that process is the sort of thing which as you can imagine, particularly trusts which have changed trustees, changed investment managers, it can be tricky, but it is possible if you are prepared. And I think the message I would give to sort of all trustees is actually, you could be asked by a beneficiary, I'd like to receive £1 million. Can you tell me how it would be taxed? And I suppose you don't want to be running around at that point, sort of trying to call accountants and say, actually, hey guys, we may have prepared trust accounts. I'm sure most trusts do. But we don't have these pools of income and gains that Ben's talking about. And the way I sort of view this process is it's the sort of thing which some trusts, they have always done it, as an annual basis. They prepare the accounts, and at the same time, it's not that much sort of additional work to, prepare the income and gains pool calculations. It's a bit like, I sort of liken it to going to the dentist. You do it once a year, you have your checkup, doesn't cost much, it's fairly painless. But you could take the view, actually, we're not going to be paying distributions for years to come. We don't need to do that. We'll do it when the time comes. And the rules might have changed by that point anyway, so that's why we're not doing it. But then all of a sudden, you find yourself in a position, possibly, later this year, where a beneficiary says, actually, the time's come, I really would like a distribution. And then you're scrabbling around, and to use the dentist analogy, you are, you're going through a world of pain at that point, trying to find all the historic sort of investment records. And look, there's always a way. You never get to a point. We deal with a lot of cases where there may be incomplete records, and there are sort of views that can be taken. But it's a lot more expensive, a lot more time-consuming, doing it in one go rather than just being on top of things and ready to roll.
Okay, maybe we should change tack a bit now. You're talking about dentists. Let's go back perhaps to Tom and Grant. Before any changes can be made to a structure, we all need to talk to our clients and communicate, understand their needs, wishes, and desires. We're all set up to work remotely, and all you listening in are obviously working remotely and listening in too, albeit I actually am in the office to do this. We can communicate between ourselves, but we probably sometimes forget that not everyone has access to much more than a landline. And if working from home is going to be the new normal, Grant, do you think working habits will change, and will that have a significant impact on any sectors?
I'm sure they'll change. I think we've probably all been pleasantly surprised at how well our business continuity plans work. We all disappeared off to our burrows, and work continued as we would want it to. But I don't think we're fully representative of the community we serve. And there are plenty of stakeholders who are quite happy with their telephone and aren't iPod silver surfers. And I suspect there is a big challenge in making sure we're continuing the best practice of communication. I also think there are all sorts of other things. The way the COVID hit, and it was a sudden issue of significance, probably hid the fact that many structures had their first quarter board meetings, and they're not due another one for another, the 3-month slot is almost up. And now we've got all the transport issues. And I wonder if everybody else has seen the issues of people who would normally fly in for a meeting and fly out the same day are now looking at 14 days stuck here before they can have the meeting, and 14 days on wherever they went back to. So I think there's a lot of change in the way we're doing business, which we haven't seen yet, but we can expect to come our way. Tom, how do you feel about that?
Yeah, I think that's absolutely right. And ultimately, it's our responsibility as advisors to communicate with our clients in the way that works best for them. Because if you're giving the best advice in the world, but it isn't being received in the right way, it's worthless. I think there are other couple of themes that I just wanted to touch on that have been highlighted already by a couple of the other speakers. One of them is that the world is going to be more indebted. What does that mean on the taxation front? I think one of the things that we are seeing governments looking at is the use of financial repression. So this is a less direct tax than some of the other forms that have already been mentioned by Will and Ben. And essentially what this is the notion that investors are forced to hold government bonds at a lower yield than they would otherwise accept if they were able to allocate their assets otherwise. So this is effectively a tax, however it's disguised. And what this allows governments to do, again, talking to Will's point about the debt burden the UK government is facing, is issue debt at a lower rate. So, for example, in the auction on the 20th of May, so pretty recently, the UK government was able to issue 3.8 billion of gilts at a negative interest rate. And this is in an economy where the Bank of England is currently marginally has a positive base rate target. So that's another thing that we're talking to clients about is how are you going to make sure that you are trying to avoid those areas of the market that are seeing more compression due to changing regulation and government rules, which are then biting the returns that you're going to be taking from assets. And just one final point as well, and this is more of a sort of 2 to 5 year theme, is the retrenchment from globalization. Complicated supply chains have been problematic, and additional geopolitical tensions, which have been slightly overshadowed by COVID, but are still there bubbling under the surface, are going to cause issues, particularly for Asia Pacific countries that have been the factories of the world up until this point. So they're going to have to pivot, and it's not going to be immediate. It's going to take 2 to 5 years to work out, but we think that they're going to have to pivot away from being heavy manufacturing bases to being a little bit more domestically serving. Now, when all this manufacturing moves back to Western Europe, North America, etc., it isn't suddenly going to be a boon for manufacturing jobs there, because of course another theme that will be developing out of this will be the increased use of AI and robotics. So going to Grant's point right at the head, there are going to be winners and losers out of this, and looking forward, we can see several of those being identified quite clearly.
Okay, thanks. We've got a couple of questions to come into those, I think, now. One of them is that a lot of clients and trustees, I think this is for Grant or Tom, will be in regular dialogue, having heard the various commentaries from their investment managers about current trends in the market and how portfolios have performed. What questions do you think all clients should be asking their investment managers in the current climate?
Yeah. The one that I see a lot is the bond market comparator indexes did really well, and they have a lot of duration in them. And the vast majority of managers didn't have a bond portfolio with anything like the duration of the market comparators, and therefore underperformed. So you get a lot of the manager failed to meet the benchmark, but beat the peer group convincingly. And the answer there is really, do the bonds as presented by the current market represent more risk than return opportunity? And it's been said for years, a return-free risk, but now more so than ever, I think that will be something that people talk about. The property thing is something that we'll come back to too. Not everybody has property in the portfolio, but where they do, what's happened in that world has been chalk and cheese. If your tenant is Amazon in a warehouse, you're home and dry. And if he's somebody in the retail high street, you're probably in the deep trouble. So there's some issues there that need discussion. What do you think, Tom?
I think that's absolutely right. On the real estate side, logistics and industrial, looking forward, in most geographic areas are looking pretty solid. Retail, not so hot. Office space going to come under increased pressure. We're having discussions at UBS. We have 6,000 employees in the UK. We're talking, as we head towards the end of the year, being at no more than 50% capacity. So we moved into our premises 3 or 4 years ago. If you are a large corporation looking to take on increased office space in the City of London, and we're either in 5 Broadgate now, I'd look out and see lots of cranes. Would you be looking to go for 10 floors of a prime landmark building, or would you instead be looking at less space and using it really only for meeting clients, and where it's otherwise absolutely essential for staff to be in an office environment?
Okay, thanks. Perhaps turn back to Randall and to pick up on sort of communication. Thinking of you from my own experience out in Bermuda, you are quite isolated, and if supply chains are really quite long there, and there may well be sort of retrenchment, as we've heard, especially in Bermuda. How are you finding the communication with all your beneficiaries, because they'll presumably be quite diverse and spread out?
Yes, you're quite right. You've got some of the beneficiary settlers, advisors who are very tech savvy, and you can continue to communicate with them. But as we've heard over the last number of decades, a lot of communication is nonverbal, and a lot of communication with the trustee and the families happens outside of a traditional trustee meeting. They'll meet over dinner, over tea, and that's where you actually hear what's going on with the family. You hear the important issues that they're concerned about. So, and beyond that, the trustee is often the trusted advisor for the family. So they've come to rely on the fact that the trustee is going to stop in and see them every quarter. They get to chat about everything under the sun. And now they've suddenly lost that trusted advisor. So it becomes very tricky. For the clients who aren't very tech savvy, you've got an additional problem because they don't communicate well in this environment. And I use an example. One of our clients still uses a thermal paper fax machine and doesn't believe in the internet because it's a passing fad. So, you know, someone like that is far more difficult to communicate with, and likely relies more on face-to-face contact, which is difficult in these times. So it's a tricky problem because the trustee needs to have that line of communication open.
Okay, and the other problem, presumably, Randall, you'll be facing in Bermuda and probably also in Guernsey, but where we're facing Grant, but trustees and people who administer companies in Guernsey, is the substance rules that the EU brought in. Are you seeing much work on that to ensure companies they remain compliant?
Yes, it's an issue now. Most of the jurisdictions have lightened up the requirements and have postponed the introduction of the economic substance as it goes into play. But it starts to become a concern as people look forward in their structures. Now, in Bermuda, we've always had this issue because every now and then hurricanes love to fly through here and rain and blow things around. So we've been prepared for that sort of disruption. But it's not common that you have months and months of hurricane type disruption in your business. So that certainly impacts economic substance. And as people revisiting their corporate structure, saying, do I need all of these various, and the compliance people hate it when you talk about layers, but do I need all these layers of corporates in my structure? Can I simplify it? Can I move it into a single jurisdiction? How can I make it work better? So it certainly becomes an issue because mind and management needs to be exercised within the jurisdiction of the corporation if you're engaged in a relevant activity. Your thoughts, Will?
Yeah. Yeah, from Guernsey, I think, Randall, that's a similar experience. The people who were well organized quite a long while ago. But as with the tide going out, and no doubt we'll find some people who skimped and didn't think through, and they've probably got a rock ahead of them. But I haven't seen too many of them in Guernsey at the moment.
Will, do you want to add anything on that?
Yeah, just briefly to add, I completely agree, Randall, with what you've said. And Grant, you touched on this earlier. The substantive requirements, obviously, they differ slightly in each regime, but they basically all come from the same place, which is a reaction to the BEPS, the OECD BEPS project, and to the EU pressure following that. And so one of the things they focus on significantly is physical presence at board meetings and expertise of those members sitting on the board, and physical presence, numbers of employees. These are the economic substance issues that these rules look to. And Grant, you mentioned earlier that there's a specific problem if directors who fly in for meetings are prevented from doing so. So I think we're going to see, and we probably are seeing, two immediate reactions. Randall, you touched on one of them. Offshore and onshore financial centres relaxing their rules a little bit and encouraging more forms of participation where that's appropriate, and maybe taking the pedal off the financial penalties for a bit. And perhaps we're also seeing businesses looking really carefully at how their boards are constituted, and maybe making some adjustments there to bring in people with deep expertise in the right place, and indeed maybe having people not join certain board meetings where they are physically incapable of doing so from the right place. Because that mind and management point, Randall, you mentioned, when it's UK focused, the management and control test, it's a real issue. And although HMRC have said they will be friendly on this, they've also said in turn that is time limited. And I think, people are well advised to be cautious there.
Okay, thank you. Perhaps to change tack, one thing we haven't perhaps mentioned very much is borrowing. And I know, Tom, banks are certainly always willing to lend to our clients who already have lots of money. And I always wonder why they wouldn't lend it to me. But we haven't mentioned it with interest rates, that low, almost possibly going negative. Is this a good time for trusts and structures or people to borrow, if only to provide liquidity in the short term?
Yeah, it's something we've been talking to clients about, unsurprisingly, quite a bit over the last couple of months. Traditionally, the trust clients that we've been looking after haven't tended to have highly leveraged investment portfolios, but they've often had high levels of leverage in their assets they hold outside the bank, typically on real estate and perhaps also in the family businesses. As those assets have come under pressure, particularly the family businesses, they've been looking to try and obtain leverage through their more liquid financial assets, which they can then use to prop up those other assets. And actually, that opens up a slightly different conversation with trustees and ultimately with the underlying families and what they're thinking about, the way they think about their assets as a whole. Because entrepreneurial clients have a tendency to think of their business and family assets as being almost their risk-free part. So they don't tend to think of it as part of their wider financial portfolio. We have a client who has a lot of exposure in the hospitality sector, and that's been great for him for the last 15, 20 years. But suddenly that's become quite a tricky asset for him. So he's now having and he's also of a certain age whereby he's thinking of divestment and whether the next generation want to be involved more broadly. And the trustees are really engaged in helping with that conversation. And then we're there to provide hopefully a little bit of financing in the short term, the mid-term, to help support the business, and then hopefully see them out of that crisis. But then it will develop into that wider discussion around, is this a financial asset or is it a business? How do you see that as trustees as well? Because ultimately, if you have responsibility for looking at their portfolio on a total risk basis, some of those assets that looked like they were safe as houses are now looking like a lot of eggs in one basket.
Okay, thanks. That sort of leads me into thinking of borrowing and structures that borrow. Is we've seen a rise, that's probably for Will and Ben, in the use of family investment companies over the last couple of years. They've become very popular, and those traditionally have always had very high levels of borrowing, but that's more from the sort of major shareholder as a way of getting money back tax efficiently out of the structure. Do you think there might be some changes? Will, you've mentioned the government raised taxes by not cutting corporation tax and other changes. Do you think that FICs are in the danger line?
Thanks, Ed. I think they might be. It's hard to know. Just going back to rates. Rates are an easy way to bring in tax, provided you don't go too far up that curve where actually revenues start to fall again. On paper, at least, increasing rates brings in more money. And just to take a simple example, if you put a penny on all rates of income tax, VAT, and corporation tax, the revenue's own numbers suggest that you bring in 15 billion a year. So that's great, if you're a chancellor who needs to balance the book, provided that happens. So don't bet that corporation tax might not form part of the package of measures. If the government start to look at rates, I can see no reason that corporation tax wouldn't be part of that discussion, albeit that it trickles through ultimately to consumers. It might raise alone, a penny on corporation tax might raise alone sort of 2 billion-ish in a year. What does that mean for clients who have family investment companies? Well, you already mentioned, Ed, the loan funding or other forms of exit that might be designed into a structure. If clients are worried about that kind of tax change, then it's worth looking again at that structure and seeing what forms of exit there are, given the way that the family investment company has been structured. But I would add to that, and subject to anything Ben says, just a word of caution. Family investment companies are pretty attractive vehicles. Corporation tax levels are low. The participation exemption for dividends is generous. For the right clients, these structures are likely to remain attractive unless corporation tax is hiked very significantly. And that would have quite a significant economic impact. And I doubt that it's on the shopping list.
I would agree with that. Well, I think that's spot on. I mean, family investment companies, the trend is there. We're seeing more and more of them. And yeah, I think there's no doubt they do offer sort of short-term tax savings. I think most people entering them, as long as they're going into it with their eyes open, that look, at some point in the future, HMRC might get around to actually sort of focusing on these things. And actually, in the past, one thing I've always thought they might do as a way of attacking, you're right, because you wouldn't want to suddenly just raise all corporation tax simply to attack family investment companies. But we used to have something called a close investment holding company corporation tax rate, which essentially applied to sort of closely held companies. And I could see them just reintroducing something like that. But the truth is, in the bigger scheme of things, going back to what Will was saying, I think if they need to raise money to balance the books, it has to be through one of the main taxes, and it has to be essentially something which is borne by everyone in the UK. Adding a penny onto income tax or to national insurance or to VAT or a combination of everything. I think there has to be that. But what I can see, and to a certain extent, increases like that, frankly, there's not much you can do about it. That's, they come in, we all pay them, very little can be said or done. I think I wouldn't rule out sort of tax changes and tax hikes for sort of private clients. And I think actually, just politically speaking, it's always easier to introduce a tax rise for everyone if you're accompanying it with some form of increase elsewhere for wealthy individuals. So at least the government, on the face of it, can lead with the fact they're attacking wealthy individuals. But if you actually look at the figures, all these taxes we're talking about, whether it's capital gains tax or inheritance tax, the amounts these taxes actually the amounts these raise sort of are relatively modest compared to the main taxes. So I think the message is, to all clients is, I wouldn't be rushing into taking any action now that you weren't otherwise considering. But I think having your affairs in good order, being nimble, thinking about the sort of things you might, maybe there's something you've been wanting to do for a while. Maybe you've wanted to gift money to your children for, the last year or so, but haven't got round to thinking about how to do it. If you're thinking of doing it anyway, I would say get on and do it. But I wouldn't. I think just sort of staying flexible and just keeping your ear to the ground is probably the best we can say for now.
I think staying flexible is good advice for everything, especially structures. We've only got a couple of minutes left, and so plenty more questions we could go on. So thanks so much for everything you've said so far. I suppose to end up with, to move to the future, and hearing Grant, we just discussed about tax rises, but is there other alternatives? Have governments discovered the money tree and that they can just print money? Are tax rises inevitable?
I'm sure the tax rises are inevitable, yes. And yes, they have discovered the money tree, but at some stage you will get bumps along the road. And we know the changes that have taken place have been so severe, we will expect some big changes over the months and years. I mean, the one that stuck out a million miles was for American unemployment to go from 4% to 14% in a couple of weeks was a whopping change. And the kind of numbers that we come across in people's debt schedules as a government, we don't come across anywhere else. We've got no idea what these numbers are really like because they're just so huge. We don't come across them anywhere else. There's going to be some big changes, and the focus on communication, that we all talk to each other, is really important because it'll be very hard for people to understand the consequences unless they're communicating effectively.
Perhaps we'll finish with you, Randall, because communication is something that often I think of in Bermuda, and you've mentioned hurricanes, and it's like you're on an enduring hurricane. Any final words from you?
Yeah, I would just echo the earlier comments, which emphasize the importance of communication with the settlers, the beneficiaries, the families, and their advisors, especially as they're spread out across the globe. Tax changes are going to be happening, and they're going to happen fairly rapidly. And as a trustee, there's no possible way that I can know the tax laws in all of the countries around the world. So it's important that we're in constant contact with our advisors. Fortunately for us, we don't manage the money, but if we did as a trustee, I'd be reviewing my indemnity provisions in my trust deed to make sure I'm not going to get tagged. But there's some planning that the trustees should be taking advantage of now. And also, as the family's conscious of their mortality, issues that you might have had problems addressing before, like successor protectors or successor appointers or letters of wishes being updated. Now they're more aware of these things, so it's a good opportunity to use that as an opening to speak with clients, beneficiaries, settlers, and others. Yeah.
Thanks, Randall. So it looks like we're all going to be busy, so we shall end there. So thank you very much to Ben, to Randall, Grant, Tom, and Will, and also thanks very much to Dale Gorley, who's our IT man who has set all this up and made it go so seamlessly. And thank you to all of you for listening and watching. Thank you.
Thank you.